In this video, I'm going to go over my passive income dividend growth portfolio. It currently sits at a value at over $76,000, and this is a portfolio of stocks that all pay out a dividend, and that dividend is growing each and every year. I'm collecting this passive dividend income, reinvesting back into these solid blue chip companies, and then I get more and more income each and every month, each and every quarter into the future. This is a portfolio of assets I'm building to one day achieve financial freedom, so one day I can live off these dividend payments and become completely financially independent. The value of my portfolio sits at over $76,000 and has been performing very well throughout 2020. This is a portfolio of assets that all pay out a dividend, and these are some of the market leaders within each sector of the market. There's not a lot of risk in this portfolio. These are the solid blue chip companies that you hear about all the time that have a strong history of growing revenue, growing income, and very consistent, predictable future cash flows. So what we're going to do in this video is go over the key holdings, discuss why I own them, and go over my sector diversification. I'm going to share with you some of the companies that I haven't really talked about too much on this channel, and just go over every holding kind of quickly, just to give a nice overview of why they fit within this overall portfolio and my total investing strategy. If you're new to the channel, everyone, I am the Gen Z Investor, and we post about the stock market every single day, going over different stocks you can buy and sell, or any major stock market news and headlines. And in this video, like we've talked about, we're going to do a deep dive into my financial freedom portfolio. If you just take a quick look at this portfolio, so far all of my holdings have been doing very well. This column right here represents the total change in percent, and you can see almost every single one of my holdings is in the green. The only one of my stocks that is in the red still is Bank of America, and that is less than 2% decline and only a $30 price difference from where I bought in. So still, you can see my portfolio has been holding up very well. We have seen a nice recovery over the past few weeks, and some of my top performing stocks are up more than 20%. So in this video today, we're going to deep dive into these companies, and we're going to start off by taking a look at my Excel spreadsheet. So this spreadsheet is in the same order as Yahoo Finance. All my companies are listed down below, and you can see the number of shares I own, the market price for these shares currently, and this is live and it gets updated every 10 minutes, the current market value, so the number of shares I own times the market price, and the book value, so how much I paid to acquire these 90 shares of Apple, and of course the difference between the current market value and the book value is my gain or loss on the stock. I also have here the gain or loss in terms of percent for each holding, and of course, following that, I have the dividend data. So for each of the companies, I manually input the amount of dividend they pay per year. And of course, I have the current dividend yield for the share price if I were to buy more today. And I have my annual income from that holding. So if you take a look here, if you were to multiply my 90 shares of Apple times their annual dividend of 82 cents, you would see that per year, Apple pays me $73.80 in dividend income. And overall, Apple makes up 15% of my total investment portfolio and is by far my largest holding. And of course, just to show you the entire spreadsheet, I have a chart of the 52-week price performance just to get an overall trend of where the share price is going and the growth we have been seeing. Then I have the ticker, each sector for each company, and an average weighted yield for the stock. So that's kind of what I have. It's a very simple spreadsheet, nothing too complex. I enjoy having this just to give a quick overview of my portfolio. It's easy to print out, and I like having all my holdings all combined into one easy to use and easy to manage tracker. So before we actually go into each holding within the portfolio, I'm just going to show you my sector diversification. This is very interesting, and I believe everyone has a different perspective on which stocks they should own, which sectors they should invest in, and which sectors they should own more of compared to others. And of course, a really big debate is whether or not you should hold bonds in your portfolio, and I'm going to say it right now that I actually do not hold any bonds. I think bond yields are way too low. I don't think there's really any upside in owning bonds right now. And I think I'm very young, so I don't really need to have bonds in this type of portfolio. Maybe one day as I get older and closer to financial freedom, I'll want a little bit more stability. And then later on, I may add bonds if yields go up. But right now, if you take a look at my sector values for each holdings in this portfolio, you can see right now that tech makes up over a third of the portfolio, coming in at 36.6%. And that's represented here, of course, in the blue. The second largest portfolio holding is actually consumer staples. These are the brands that no matter what's going on in the world, their products will still be in demand. And I love that predictable growing revenue. And I love these strong companies that can operate in almost any type of market environment. Then the third largest, we have communication. This is really for the dividend income. The two companies are AT&T and Verizon, which I discuss all the time on this channel. Those are extremely high dividend paying companies. The dividend, I believe, for both of them is safe. Although the dividend doesn't grow very much year over year, that dividend income is a nice boost to my portfolio. Coming in at number 4, we have financials. Of course, another sector that was hit extremely hard in 2020. I am still bullish on the sector, and over the past few weeks, we have seen companies like JP Morgan actually rebound and start climbing back up to closer to pre-pandemic levels. And of course, number 5, we have healthcare. Another company which has some strong growth potential over the next year, and they have some nice companies that do pay out some growing and consistent dividends as well. And then we have some smaller sectors like consumer discretionary, utilities, and industrial as well to round out my portfolio. But I like my sector values. I don't change them too much, and I like my overall diversification of this portfolio. You can see, of course, tech is leading the market right now, so I'm comfortable owning just over a third, coming in at 36% within the tech sector. I like my around 10% weight in financials, communications and between 10-12% I'm comfortable with, healthcare at 9%, and of course the two consumer brands combined make up 20%. Overall, I do like my diversification. I have a very small cash balance right now, and that is something I do want to improve. I do want to load up some cash just in case we do see a pullback end of 2020 into 2021, just so I can take notice and use that cash to buy in over some dips. That's maybe the one sector that I am underweight in, and that is cash. Of course, that is probably the best sector to be underweight in right now because cash doesn't really do anything for you. It just sits there and it doesn't achieve anything. So at least all my money that I have in the portfolio right now is working to grow each and every day and each and every year for many years down the road. So now that we've actually gone through an overview of my portfolio, we've taken a look at all the holdings kind of at a glance, and we've discussed my sector diversification. Now we're going to actually deep dive into each company. Very briefly, we're going to go over the stock, how many shares I own, the dividend income from it, and what I plan to do with that company down the road. I only own blue chip solid companies that I never plan on selling. So actually none of my holdings in this portfolio do I plan to sell over the short term. Even if we see a decline of 10, 20, 30% in the share price for any one of these holdings, I have no intention of selling. I like the business models, and I think they will all survive over the next decade and continue to grow. So the first company, of course, is Apple. I own 90 shares of this company, and we all know them for being the largest company in the world with a market cap at over $2 trillion. This is a complete cash cow company. They're diversifying into different service revenues that I think are going to only help them expand and really boost their bottom line. They bring in a ton of money each and every year, and I don't think that's going to slow down. And one thing that's a great sign for Apple into 2021 was that the actual iPhone sales were their slowest growing sector of revenue. The iPhone wasn't really growing and generating more and more revenue each and every year. But we just got a report that Apple aims to make 30% more iPhones in the first half of 2021. And if this report is true and Apple does increase supply by 30% and the demand is there, I think the top and bottom line for Apple is only going to grow dramatically over the next calendar year. And I think the share price will be highly reflected in that trend. And we will see a huge year for Apple over the next 2021 and beyond. And I think this is a company you can never sell. I don't understand why you could sell Apple. Even for the people who own a simple S&P 500 index fund, Apple is your largest holding. And the second company in my portfolio is Microsoft, the second largest company on the market, another dividend-paying tech stock, and I own 44 shares. For Microsoft, it makes up around 12% of my portfolio, and you can see combined, Apple and Microsoft make up more than 27%, or more than a quarter of my overall investment portfolio. That is because I'm extremely bullish on these companies. Even when they're at all-time highs, I would buy more. I really like their brands. I really think they're going to continue to grow, and I really don't see anyone that can stop them. And with Microsoft, one thing I really like right now is the growth of their cloud services. This stay-at-home economy has sent the demand for their cloud products absolutely skyrocketing. And you can see over their latest quarter, their cloud strength fuels their latest results. Revenue has gone up 12%, operating income went up 25%, net income increased 30% during a year of a global pandemic. And some of their cloud products saw 9 and 21% revenue growth. And of course, the Azure platform, their main cloud infrastructure, grew 48% year over year, which is absolutely incredible to even think about. huge driver of net income for the business, and I think Microsoft is only going to continue to dominate for many years down the road. And even at the price point where it sits today, I love this company and always think about buying more. The next two stocks I own in the tech sector are Visa and MasterCard. Of course, these are more financial tech, but I consider them a technology company just because of where their future lies. So these two companies dominate their respective industry, and that's why I own both. These companies are primarily a growth play because they both pay very tiny dividends. And although their dividends are small, they grow and they compound at a tremendous rate, and both of these companies are averaging more than 20% annual dividend growth over the past 5 years. And for both of them, I am up big, up 14% on Visa and up 7% on MasterCard. And I still think I'm underweight in this industry because these companies both have $300 to $400 billion market caps, but I see them hitting that $1 trillion cap very soon. And so do other analysts. They believe Visa and MasterCard, with the way of our new digital transformation, can really dominate that industry and will become trillion-dollar companies not too far along in the future. So if you were to buy in today for a company like MasterCard, for example, with around a $300 billion market cap, you have the potential to see your investment double or triple over the next few years if they're able to hit this $1 trillion feat. And of course, I like these two companies, and why I own both is because they control 90% plus of the credit and debit card market. You can see here, Visa holds 60% market share, and MasterCard is second with 30%. So combined, my holdings in my personal portfolio own 90+% of their industry. Their industry, the Visa debit card space, is extremely hard to get into. Not a lot of companies can just come out and compete with these two type of brands. And with their new way of digital infrastructure growing, I think they're only going to continue to dominate forever. And with Visa and MasterCard, I love owning both because I control the whole industry. So I like these companies. I don't plan on ever selling. Again, two brands I love long term. These companies have seen tremendous share price growth, and I like owning all of them. They kind of control their market, and I really like these type of brands. They do not provide me with a lot of dividends, of course, because the yields are so low. And if we take a look at right here, I receive $14 a year from MasterCard and $25 a year from Visa as dividend income. Now moving on to the financials, I own 4 major banks: JP Morgan Chase, Bank of America, Royal Bank of Canada, and Toronto Dominion Bank. These companies dominate the financial industry within North America. JP Morgan and Bank of America are leaders within the US, and Royal Bank of Canada and Toronto Dominion Bank are leaders within Canada. In Canada, people might not know this, but they have one of the strongest financial systems in the world. They have 5 major banks that control the entire country's financial system, and Royal Bank and Toronto Dominion are the 2 largest of the top 5. So I like owning these companies. They really dominate within North America, and even during the 2020 decline, I was buying more financials. I'm very bullish on this sector, and you can see it makes up over 10% combined over these 4 holdings. These stocks also provide some nice dividend income as well. If we take a look here, once I scroll over, you can see that I've received $72 a year from JP Morgan, $43 from Bank of America, $78 from Royal Bank, and $103 per year from Toronto Dominion, or TD Bank. TD Bank, of course, is one of Canada's largest bank, but they actually generate 40% of their total revenue from within the United States, so nicely diversified between both countries. And in total, my financial sector dividends come in at around $300. And one thing I want to point out, we're not going to deep dive into all of these companies' performance because they're all financial companies, they're all major banks, and they all been kind of doing the same thing over 2020. But one thing I want to point out is how resilient companies like JP Morgan are. Even during this tough time, we're going to take a look at their net income. Banks were expected to post massive net losses. Everyone thought this was the end of the financial system as we know it. But if we take a look, this is the chart of the quarterly revenue for JP Morgan. You can see pre-pandemic, back in 2019, $9.1 billion of net income. Then dropped $8.5 billion in the fourth quarter of 2019. Then the pandemic hit. They had huge loan loss provisions. They had massive expenses preparing for different loan deferrals and loan not payments coming in. So you can see in March that absolutely got hammered, but they still were net income positive. JP Morgan still had close to $3 billion of net income during the height of a pandemic that was supposed to end the business. Then the following quarter, that went up to $4.7 billion. And then September ended quarter 2020, $9.4 billion of net income. And I want to point this out. $9.4 billion in 2020 compared to the same quarter in 2019 had 9.1 billion. So they actually grew net income by $300 million over the same 90-day span during 2020, going through a global pandemic that was supposed to end the financial system. That's how strong these companies are. That's how resilient they are. And with strong management, I'm a big fan of JP Morgan CEO Jamie Dimon. I think this will continue to grow and go back and actually surpass previous net income levels. And banks like JPM, Bank of America, are known for rewarding their shareholders with huge dividends. And once they are allowed to continue to grow that payment after the Fed, releases those restrictions, I think they absolutely will. And I think the financial sector is only going to continue to dominate down the road. And all of these companies, they're adapting, they're innovating, they know that digital banks are growing in popularity, and they're doing everything they can to compete and dominate that market as well. Moving on, now we have communications. Only two names, of course, AT&T and Verizon, the market leaders, and they form somewhat of an oligopoly. There's only a few massive brands that control the communication sector, and these are two of them. These companies are absolutely massive with over $200 billion market caps for each, and they also provide some huge dividend income. We all know AT&T current yield at 6.8%, and the share price has recovered. I bought into AT&T with around a 7.1% dividend yield, and the payout ratio is only 65% of their earnings. Plus, they're doing a nice job at reducing their debt level. I think AT&T is still a solid dividend-paying company. Next, of course, we have Verizon, a yield at over 4%, very safe payout at only 51% of their earnings. Plus, this company's share price actually does grow over the long term, so a nice total return from Verizon as well. So that's the communication sector. Nothing too crazy from this. It's kind of known what companies I'm holding. These are the two major dividend-paying companies, and this is really the only sector of the market that still provides some nice high yield even during the run-up we've seen over the past few weeks. Next, we have healthcare, and I own 4 names within this sector, and all of these companies pay out a nice dividend as well. Of course, the safest company and one of the best companies on the market that I'm extremely and always bullish on is, of course, Johnson & Johnson. The dividend king, I don't see them going anywhere anytime soon. They just completely dominate the overall industry, and I do love, and this is one of my core holdings and favorite holdings within the entire portfolio. Next, of course, we have AbbVie. I bought them for their massive dividend yield plus the share price growth, and they do have one main drug that does dominate their total top line, but they're doing a nice job of diversifying to get greater revenue streams to not solely rely on one product for a total of their top line revenue. Then, of course, we got Merck and Pfizer. Pfizer, of course, is a vaccine play. They have a nice 4% yield when I bought in. The dividend is still considered safe, and with the potential for their share price to surge as demand for their vaccine grows, and the fact that they are now actually getting that vaccine shipped around the country and internationally, I think the company may see a lot of upside potential into 2021. And finally, Merck, just another strong healthcare player. They've made some strong acquisitions, and I really do like the brand name over the next few years down the road. If we take a look at the dividend income provided from these companies, you can see here that they do make up a sum of around $250 in total. $75 from AbbVie, $84 from J&J, $39 from Merck, and $46 from Pfizer. So another portfolio of assets that I do like long term. Again, no plans on selling and do plan to hold for a very long period of time. Now we have some consumer names. We have companies like Home Depot, Lowe's, and Costco that I'll discuss first. And these are retailers. Of course, we all know Home Depot, Lowe's, and Costco have physical stores that you go in and shop from. Costco, I think, has one of the best marketing strategies and best retail, plans to dominate the industry. I love their warehouse style of stores. I think they have extremely loyal customer base that isn't going anywhere anytime soon. And the fact that a ton of their net income and a majority of it is driven by memberships is absolutely incredible. And then, of course, Home Depot and Lowe's. Lowe's is a dividend king, proven to continue to grow that dividend through good times and bad. And then we have Home Depot. Home Depot is the larger company by market cap, and they both continue to grow at a massive rate, and I like owning both of these companies because my perspective for this sector is that Home Depot and Lowe's are not going anywhere. The products they sell, the tools, the hardware, the furniture, the home improvement necessities, I don't think you can really buy those online. I don't know, I'm sure people do, and both of these companies have a nice online infrastructure, but I think these two stores are built for in-person retail. I think just the products they sell require you to go in, check it out, and see firsthand what they look like and what you're getting. I don't think it's really going to turn into a fully online digitized business, and even if it does, Both of these companies have a nice infrastructure already set up, and I don't see many other competitors competing with them at scale. They dominate their respective industry, they're known as the two market leaders, and those are the companies that I like to own in my portfolio. And one thing I want to point out is that both of these stocks grow their dividends by huge rates each and every year, averaging massive dividend growth of 15+% per year. And the next two companies we're going to take a look at are Procter & Gamble and Kimberly-Clark. Again, two companies I don't see going anywhere anytime soon. Procter & Gamble, a very long-term dividend king, they actually raised their future guidance for 2021. They have a higher perspective and see greater revenue and sales growth than previously stated. They bumped up future guidance, they're going to have a strong calendar year, and they operate within 10 main retail sectors. They have 10 overall product lines, such as healthcare, baby care, feminine care. All of these type of sectors are huge necessities. They have dental care as well, oral care. And these are products that regardless of what's going on in the world, people need to buy them. They have, of course, they have diapers, they have everything and things everything that you have in your house that you use on a daily basis or weekly basis that are absolute necessities, Procter & Gamble is involved in, and that's the company I like to see. Extremely resilient, a 60+ year dividend growth streak. They have proven to survive through almost everything that could happen on the market, and I think this will be a core holding for decades down the road. They own some of the strongest brands that dominate the shelves of retailers, and I don't see any other brands kicking them out of their retail dominance. And number two, in the sector of consumer staples, Kimberly-Clark, another product company that does sell necessities. I do like them. I think owning both PG and Kimberly-Clark kind of gives you a diversified stream of revenue from core products that aren't hitting off the shelves anytime soon. Next, we have some of the boring sectors. We have utilities, Duke Energy, Southern Company, and Next Era Energy. 3 utility brands all provide some nice dividend income, a slower growth sector of the market used for the dividends that are all over like 2, 3, 4%. Nice passive income from these companies, some of the largest utility companies within North America, and I collect those nice quarterly payments that grow at a decent rate year over year, and that's pretty much all I'm going to say about the utilities. And finally, the last holding in the portfolio is Canadian National Railway, ticker CNI. Bill Gates is actually one of the largest shareholders in this company, and I love their infrastructure. There are really only 3 huge high-end railways that dominate within North America. That's UNP, CNI, and CP. Those are the 3 railway companies. Of course, there's more smaller ones that absolutely dominate the infrastructure. And they're not really building new railways. Railroads are kind of an older technology, but are still a necessity. There are still a ton of products and services that can only be provided through railways and rail lines, and those are not going anywhere anytime soon. And I think the existing 3 main players are still going to dominate. This is one of the best companies, has provided a total return beautiful over the past decade, and I think that will continue to happen going forward. And it is my smallest sector of the market, of course, with industrials, it being its only holding. I may add one other industrial company. I'm still looking into it. We will see what I find, and if I do make a buy, of course, I will update you in a future video. So that was an update going over all my investment portfolios. I haven't really made a video like this before, going over each company very briefly and discussing some reasons why I own them within the portfolio. Overall, this portfolio sits at a value of over $76,000, which is absolutely incredible. I started investing heavily back in 2019. Then in the beginning of 2020, I decided to take this very seriously and start going hard and providing as much capital I can in this portfolio. Warren Buffett and Charlie Munger are known for saying that the first $100,000 invested is the hardest, and from there, you actually start to notice the growth and the compounding working in your favor. So I've been plowing a ton of capital into this portfolio. A majority of it right now is capital that I've put in myself, and this is just from working 2 jobs consistently every single week, contributing more and more, being extremely disciplined, not buying dumb stuff that I don't need, and focusing on acquiring assets when I'm young that will grow and provide me huge rewards decades down the road, and one day I will hit financial freedom. So thank you for watching, everyone. I am the Gen Z Investor, and see you in tomorrow's video.